Well, good morning. How's everybody doing? Can you all hear me loud and clear? Hello, Brenda. Where you been? I'm just kidding. Uh, my coffee machine decided to be slow. I always have to get one right before we start. It's still early out here. Actually, it's not. It's 9 o'clock on the West Coast. Not that early, but early enough to still be drinking coffee. That's not what I wanted on there. I wanted that. Hello, Paula. What's up, Helen? Thank you, Kevin. Hello, Stephanie. Your friend is there, Brenda. She's up there sleeping on her heat pad. Yeah, it'll be 12 noon here. I'll still be drinking coffee too. So, welcome out to Trading Coaches Playbook. If you're new here, see lots of familiar names, but it's always good to have new people too. So, we're going to have a little bit of fun. We're going to kind of sort of get back to basics, but also a very critical, topic that if you're not familiar with it, this will probably change the way you see something. So, it's something that I use on pretty much a daily basis. So it is very, very important to understand why and how it works. So let's get to it. But first, I'm not a registered broker, dealer, or investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. All right. Before that, here's all the stuff that's coming up. Inner Circle, 26th at 7 and March 4th at 7. Mastermind Group, the 27th at 8 p.m., March 5th, 8 p.m. All these are Eastern time. Monster Market Movers, February 28th at 8 p.m. 3 days in a row, right? Mastering the Trade, March 6th. Trading You, this one, March 11th. Oh, not this one. This is Trading Coaches Playbook. See, I need more coffee. Trading You is March 11th at 8 o'clock Eastern time. And then power option plays every Tuesday and Saturday. Cover Call Explore with Trip on Thursday. Free online workshops or the Power Hour every Monday at noon. Trading Coaches Playbook, this one every Friday at noon. And then Art of the Cash Flow is the 22nd and the 29th, leap year day, 8 p.m. We get one extra day this year. And the market's open. It means we have, 251 trading days? It used to be 251 trading days. There's one day that I think went to a holiday. Last year or the year before? There used to be 6, it seems like, and now there's 7. I don't know. I don't pay that close attention because it's only a handful of days a year. So, but it seems like we lost one day to a holiday. Oh, Juneteenth. Thank you, Trip. I figured it was something. It tells you how much I pay attention, huh? It's funny how we get into our little bubble, right, of things we do. And I've gotten to that place several years ago, but I do my thing. There's E-mini think tank too. Many ways to start with Brandon. Didn't want to miss him, skip in out of him, but we get into our own kind of routine and what we do, and then we kind of just block everything else out. So I don't, and that's not a bad thing. It's actually, I think it's a good thing. It's real easy to get caught up in that, especially when you're new and you're still learning. You're chasing all the flashy stuff and doing this and doing that. And it's not a bad thing. It's good to play and test and figure out what trading style, what strategy works for you, what technique, what kind of setups you like from a technical analysis standpoint. So there's a lot of things to figure out. So it's a good thing to go through those and do different things and test out different things to figure out what works for you. But once you get to that place where you know what works for you, stick with it. I use the analogy of McDonald's or any restaurant, really any business, right? You've got your core product, if you will. I mean, McDonald's is the Big Mac. That is their core product. I don't know what the numbers are, but I'm sure they make more money on that than anything else. And then they have their other core products, and they don't add new things to the menu. They do occasionally, right? They test out stuff. Here's the core menu. Here's our core 5 products. But then sometimes we'll throw something new out there and see what happens. I remember learning this, it's been 30 years ago, with Taco Bell. I was reading some business book, and Taco Bell came out with a 7-layer burrito. And I remember it because I fell in love with it. I thought it was awesome. It was really good. I used to get one almost every day. back in the old days when I worked in a tire shop. And they were cheap. They were 59 cents or something, I think, when they came out, or 79 cents. Now they're like $4. It's crazy. But yeah, they were good and they worked. People liked them. It was popular enough that they kept it on the menu. And now, as far as I know, I don't go to Taco Bell very often, but it's still it's still part of the menu because there was enough traction. So same thing in trading, right? Figure out what your core strategy is, figure out what your core setup is, what your personality is, what trading style works for you, and then stick to that. And if you want to play out here on the fringes once in a while and test other stuff out, go for it. But just make sure you stick to that core, what works for you. And that's where I've gotten to several years ago where, I'm a patterns guy. I'm looking for a pattern. I'm looking for something that says now's the time to enter the trade, and just waiting for those to show up. The last 3 months with this crazy market rally, there hasn't been a whole lot of spectacular patterns. And it's kind of weird. I'm mostly on the sidelines where I wish I had a bunch of calls or owned a bunch of stock on stuff that was going crazy north, but there was no setup, nothing for my style of trading that said now's the time to get in. So, yeah, I mean, I'm mostly on the sidelines right now, just kind of waiting for something to develop that says, here's the time to pull the trigger. So there's lots of other opportunities, but it doesn't fit into my box. So I've learned the hard way to stay in my lane and do what I'm good at. So hopefully that all makes sense. But of course, you can find us on all the social media platforms. And then here's the 3 different things I have: patterns in a flash, which is today what you're going to see. If you want to go back and see it, it is a kind of a review of one of the sections of this tool. So yeah, if you haven't experienced patterns in a flash, I would say go get it at least once. Of course, you have a 2-week trial, so you can go in there. There's about 8 hours of video. There's flashcards that train your eyes to see the patterns. There's quizzes, which I put in there as a good way to review. Didn't realize how much people would love them, but they do. And they are good. Quizzing and testing is a good way to find out where you're at, right? From a knowledge and education perspective. Weekly Whispers. That's I do an hour to an hour and a half video once a week, and then about a half hour, 45-minute video another time a week. Thursday nights, I do all my research. I look for my trades. I look for my candidates. And then I just do a video on here's what I'm looking at. Here's my big picture view. And then we go back and review last week because I got some feedback that people loved it. So we review last week and what happened and what did hit, what didn't hit. And then we look at candidates for this week. Here's my trades that I'm looking at. It's 17 or 18. Usually I have about 20 or 30. It's a little slow with regard to patterns right now, but I typically have about 20 or 30 candidates that I'm watching for the week. And that's all I watch for the week. I don't go hunting for candidates every single day. It's too much time invested. It takes me 2, 3, maybe 4 hours to do my research, find my candidates, narrow it down, set up the plans, and be ready for the week. And I do it once, and that's all I watch. So I basically just put that in video form, explain what I see, what I'm looking at, and then you can decide what to do with it from there. So, and it's small account, big returns. If you're working with a smaller amount of money, that's a class I did. It's pre-recorded. All this is on demand stuff, right? You can get it anytime you want inside your My Accounts page. So, thank you, Lee. There is a link there for the trial for Patterns of Flash if you want to jump on that. I have a feeling the Weekly Whispers one will pop up. Thank you, Lee. Beat me to it. So we're going to talk about role reversal today. And this is an interesting concept that, like I said, it pretty much shows up on almost a constant basis. It happens all the time. And we'll look at some examples. But the first most important thing is to understand the basic concept and why it happens. Why does old support become new resistance? Because you've heard that, right? You've probably heard that old support becomes new resistance. We call it role reversal, same thing, potato, potato, right? But we have 3 different groups of traders out there, right? There's the longs that are bullish. There's lots of those right now. And then you've got the shorts that are bearish. I'm kind of lonely over here in my bearish camp, even though the market's making new highs. I'm still longer term bearish on the market. I don't think we're going to stay up here, but we could keep running for a while. There's a lot of similarities between 1999 and what's going on in the market right now. In fact, there are similarities that are even more bearish now than they were in 1999. But here's the beauty. Even though from a macro perspective, my big picture view is bearish, I still don't care which way the market goes. Because as a trader, it doesn't matter to me. I just entered a trade just before we started here on, I put an order out for one of the weekly whispers candidates this week that is bullish, and it's actually pushing up through resistance. And if it breaks, I don't care. It's going up. If the market goes up and it goes with it, great. I'm going to make money. I'll get out, whenever it stops out. If it's bearish, great. I don't care which way the market's going long term. I have that big picture perspective, but on a short term basis, it doesn't matter, right? The third group of traders is the uncommitteds. Those that want to be long or short, but they haven't made a decision. They haven't put their money to work yet. So, well, there we go. I got ahead of myself. So they're either not in a position, right, which is mostly where I'm at, or they've already liquidated, right? They got into a position and they either got stopped out or they've taken profit. And they may be looking to get back in. So here's what happens with role reversal, right? A stock is, say it's dropping, it comes down to a support level and it bounces. It rallies up. The longs are happy, right? If you bought at the support level, you're like, woo, keep going, right? You're cheering it on. You get out your pom-poms and start waving them. Right? Anybody ever done that? I don't have any pom-poms, but if I did, I would. All right. So, and then of course you wish you would have had more. The shorts, if you got short at that point, or maybe let's say it dipped below the support just a little bit, which triggered an entry for a short side. Now you're on the wrong side and you're unhappy because you're upside down. That's not a fun place to be. Excuse me. And then the uncommitteds, those that didn't pull the trigger at support, are cranky. Anybody ever been there? You're like, I should have gotten in. Right? The woulda, shoulda, coulda syndrome starts to kick in. Well, I should have gotten in. I should have bought. So you want another buying opportunity, but you don't want to buy it here because it's already rallied enough that the risk reward's not worth it. So sure enough, the stock pulls back. Now what happens? Well, the longs that wanted to buy more maybe add to it. The uncommitteds may get in. And then what happens? Let's say it breaks support. Now the longs are like, wait a minute. I got to put these pom-poms away. Because they were all excited just a day or two ago or a week or two ago, however long it took to bounce. It bounced a little bit and then rolled over. And all of a sudden the longs are going, uh-oh, maybe this wasn't the right move. Maybe I shouldn't be in this thing. So the smarter traders probably have stops in place, which are probably getting triggered, right? They're going to sell, get out, exit their trade, recognize that, okay, I was wrong. This thing didn't hold support. I'm going to get out of the way just in case. And forgot to turn my phone off. It is possible, although it probably isn't happening a lot right now, but may get a margin call, right, which forces them to sell. But the break of the support level creates selling pressure. Bottom is cut off. You mean, talk about the screen? Are you talking about the screen or something else? Help me out, Brenda. Oh, it's on your end. I was gonna say it looks normal to me on my end. It looks like you can see that too. Okay. All right, no problem. Now that we've broken support, the shorts that didn't get out are now happy, right? Because now they're profitable and maybe they want to add to their position. And then the uncommitted traders, those that are waiting for a break of support, they may enter the trade. So you've got the bulls either exiting or wishing they would have exited. The shorts are happy and wish they had more. So it's flipped, right? Before the longs wanted more. Now the bears want more. And the uncommitted traders, those that are trading breakouts to the downside, they may pull the trigger on a short trade which all creates selling pressure, right? But here's the other thing. If you got short up in here or anywhere in here above the support level and it comes down and breaks here, what are you going to do? You're going to take profit at some point, right? And that profit taking from the shorts will create some buying pressure. Because if you're not familiar with shorting, right, you're selling the stock before you buy it. And then in order to close your position, you have to buy it back to close. That's why in bear markets, a lot of the rallies are extremely volatile, right? Because you've got the bears that are playing the downside. They're shorting it like mad, and then it drops off enough that they start taking profits, and that creates buying pressure. And it creates a lot of these whipsaws in a bear market. So then it bounces back, right? Some of the shorts come in. Maybe some of the longs are dollar cost averaging. Whatever the case is, we get a bounce at the next level of support below this one. It rallies back up to the previous support, right? And old support becomes new resistance, right? Role reversal. The longs, those that got long here, that were all excited here and happy, now, after we get down here, they're cranky and upset, and they're not thrilled. If they didn't get out, if they didn't stop out, they're upside down, they're underwater, and they want to get even. Because taking a loss, no, we can't take a loss, right? Hopefully you're not in that mindset, right? Take a loss and get out. But a lot of people don't. They need to get break even for their egos because I don't want to lose. And then there's three bearish players, right? There's longs, those that got long on the breakout or maybe even up above support if they were expecting it for whatever reason to do this. They're already in a profitable position. They want to add to it. Because shorts, for the most part, those that short the market are generally speaking more sophisticated than longs. So you have to, if you're looking at people that short the markets, you have to essentially give them a little more, I don't know what the word is. I can only think credit's the only thing. Because new traders or those that don't short the market, that aren't familiar with trading, that are just investors, they don't understand shorting. The vast majority of people don't understand shorting. They don't do shorting because they don't understand it. And they think it's highly risky because they bought into some BS that somebody told them. So typically speaking, those that are shorting the market are more sophisticated than those that just go long, generically speaking, right? So you got to give them a little more credit that they're more sophisticated. So if you got bearish at the break of the support and it's rallied back up and it's now at support, they probably are well aware of this concept of role reversal. The shorts are. So they're going to look to add to their position. Breakout traders are probably looking at re-entering, right? Because, and one thing I often do is on a breakout like this, which is my style of trading, I'm looking for some kind of pattern, even if it's just a support that's breaking. If it breaks there, I'm entering the trade on the break. If it drops a decent amount, I will take some profits. Typically, I will scale out, right? Say I buy 10 contracts here of some puts. It drops off enough. I'm going to take profit on maybe half of it, maybe a third, maybe 2/3, just depends on how strong a move it is. If it's really strong, I'll let it go. Might only take 2 or 3 out. If it's a little bit weak and volume gets light, I might take out 6 or 7 and then see what happens. It rallies back up here. Now I'm looking at this going, okay, we've got old resistance or old support should act as new resistance. So I'll reload into a full position if I get a decent setup. If something shows up here that says it's time to get back in, I'll get back in and I'll re-add to my position. So the breakout traders are re-entering. If you're a conservative breakout trader and you wait for this, right, because that's what the conservative breakout trader will do. Now, I play kind of both ways. I play aggressive, but also conservative. I'll play the breakout here, but I might only do a smaller position. Maybe I'll do 5 contracts instead of 10. Pluck out 2 or 3 if it starts to bounce, maybe put a stop here. If it comes back up here, reload. Some people don't like to trade the aggressive spot. Some people wait for the break to be confirmed and stay down here below support, and then they'll wait for a retracement and wait for the role reversal. That is a more conservative way to play it. What I've learned the hard way is that by doing it that way, sometimes you miss some big moves. Hence the reason I like to nibble on the break. I like to take a small position. I'll scale in. I'll pick up maybe 2 or 3 contracts here, maybe 5, depending on the break, depending on the situation, and then add to it here. And just kind of jockey in and out, if you will. But regardless of that, okay, you've got several different people. You've got the longs that want to get even, that bought in here. They just want to get back to even to protect their egos. The bears want to add to their position, especially if they're short long term. The shorter term traders, like most of us, are either adding to their position or this is their entry point. And then that becomes resistance and the whole game continues, right? This is essentially the concept of what role reversal is. Excuse me. The psychology behind it, which is the most important part to understand, is human ego. That's literally all it is. That's what creates it. Because the people that bought here don't want to lose. And so maybe the stock's at 20 bucks and it drops all the way to 19 here. And they didn't stop out. They didn't have a stop. And so it gets down here and they're freaking out and panicking. They're going, I'm underwater. I'm underwater. I don't want to lose. They put a sell order up at 20 bucks at their break-even spot. And so it gets to 20 and they sell. Everybody else unloads. Now, the interesting part, and I go in depth into this in Patterns of Flash, I talk about it in this and the round numbers section. I used to believe years and years ago that this was just the rookie traders that were doing this. And then I think it was 2010, 2011, maybe it was 09. No, I think it was 2010. I think it was late 2010. A guy I grew up with up until sixth grade. He moved away an hour north of us in sixth grade, so lost contact with him, but found out he was in New York City. But as kids, we grew up together, grade school, we family friends. So I found out he lived in New York. I was going to be back there for a workshop. And so we ended up meeting up for dinner. And I had no idea what he was doing. I hadn't seen him since, I think, high school graduation, which was a long time ago. And it turned out he worked at a hedge fund. And when I heard that, I was like, woo, I'm going to pick his brain. Because I never talked to anybody that worked inside of a hedge fund, that worked for a hedge fund, right? And then he found out I was a trader, so we started talking about this stuff. And it was funny because unbeknownst to him, he explained the role reversal concept and the round numbers concept from a hedge fund's perspective. But I honestly don't think he really truly understood what he was saying from a technical perspective, because he wasn't a technical trader. He was a fundamental guy. Their whole fund was fundamental. They were buying stocks based on fundamental analysis. He would fly out to California for a few days and he was following tech companies. He'd go to the Intel, the earnings meetings, whatever they are, all those different ones, the analyst meetings. He'd fly out and go sit down and pick their brains and ask them and listen in and do all their analysis, digging into the numbers, seeing what their future sales are, all that fundamental stuff, right? He wasn't a technical trader. He did say they used the 50 to 200-day moving average. That was the only technical stuff they used. But what was funny is he explained a scenario where, and I don't remember how we got onto it, but he explained a scenario where either he, and he used to, this was after the 08 crash, because before the 08 crash, he had $40 million at his disposal to do whatever he wanted with. After the crash, when their fund went from $3 billion down to $300 million, they lost like 90% of their capital. He had to go and pitch his ideas and give his analysis to his boss, and then his boss would make the decision. But what he did was explain to me that they would buy a stock. They'd go in and buy a million shares of this stock at 20 bucks. And then it would break down. And all of a sudden they decide, they're like, this thing's a piece of crap. We don't like the stock anymore. It sucks. It should have done it. It should have gone up, and they're underwater. Right? And whether it's your money or the fund's money, you don't want to lose, right? If you lose the fund's money, you lose your job. If it's your money, you're losing your money. And then he said, so we're underwater, right? We buy it at 20, it goes down to 18, and now we think it's a piece of junk. We don't want it anymore. So we just want to get out, break even. And when he said that, alarm bells went off in my head. I'm like, wait a minute. He just explained to me role reversal, but from a hedge fund's perspective. So this idea that I used to believe that this was just rookies that were doing this, all of a sudden here I am sitting with a guy that works at a hedge fund that is explaining role reversal to me from a fundamentalist perspective, not having any clue what the technicals are, but he's literally explaining this concept from a psychological perspective. and essentially telling me that hedge funds do the same thing. It's not just rookies like I used to think. It's the big boys too. They succumb to emotions just like you and I do. That was a massive eye-opening moment for me. I was like, wow, these hedge fund guys are no different. Because if your boss gives you $40 million to trade with and you lose it, you ain't going to have a job, right? So you're going to protect that. You're going to protect your job. And a lot of hedge funds are started with rich guys that have put their own money into it, right? So it's their money if they're doing it. But it was really eye-opening, like I said, to recognize and understand that it wasn't just the amateurs that were doing this. Everybody succumbs to it, even the big boys. So, make sense? Here's just a couple examples. Then we're going to go look at other charts too. There's actually one happening right now as we speak. It's a little company that has made the news in the last day or two. So you can see here, right? You've got this thing dancing on support. It breaks down, comes back up, taps that resistance level. And again, it's not exact, but as the old saying goes, support and resistance line should be drawn with a crayon and not a pencil. It breaks that support level, rallies up, taps it, and then drops. So there's actually basically kind of a little descending triangle here. So this is one of those that if you trade like I do, then you're probably nibbling on it right here, maybe pulling a little bit of profit. And then when it gets back up here, you reload it. Because not only do you have a trend line here you can see, which it comes back up close to, but you got the old support level that's acting as new resistance. So you put a hook down below, we come back up and tap it. You put a hook down below it that says re-enter the trade or enter the trade, depending on whether you're conservative or aggressive. And then you take advantage of this move here. We break this support, and guess what happens? Boom, it pops up, taps it, rolls over, comes back up again, taps it, gets a little above it, but then it comes back down. Now, it doesn't always happen. You can see here, you could draw a line right there as well. So is it 100% accurate? No. Just like anything, patterns aren't either. Patterns are spectacular. They give us higher odds, but there's nothing in the market that's 100% accurate all the time. Nothing. Never has been, never will be. It's just like seeing people are going to be always right. I mean, I was wrong once, but so that's proof that we're not always right. But you can see how often it happens. And same thing on the bullish side, whether you're bullish or bearish, you got a resistance level, it breaks out, pulls back, taps it. So if you're a little more conservative, you wait for this retracement, gets back to the old support, and then it rallies from there. Exactly, Brenda, just once. You caught that. I know. I love that joke. I use it all the time. Not everybody's right. I know. I made a mistake once too. But you can see how it works out. And sometimes they're really subtle. Sometimes they're more definitive. So just depends on your style of trading and how aggressive you like to get. I still haven't kicked that cough. It's lingering a little bit. But let's go look at some charts. Go back a little bit. I don't know if there's anything here. Well, you can see examples all over the place. We could find examples all day long. But here's the one I was talking about is Google. Yeah, they've gotten some bad press in the last day or two. But which is no surprise. It's a love-hate thing with Google. A lot of their stuff is great, and some of it is just trash. But you can see there's a very nice, very solid trend line that's in place here over the last few months. And it breaks just about a week ago. Let me make that bigger so you can see how big I can make it. There we go. That's a good way to put it. Love to hate it. So we've got the trend line in place. It breaks below it about a week ago, stays down here, and then yesterday it gaps up, taps that line, and sells off. And by the end of the day, it rallied back up, but that leaves us almost a hangman here. Not quite. The body's a little too big. The shadow's not quite as long as it should be, but today we've dropped off a little bit. So as of right now, we've got a roll reversal that is just starting. If you go to line charts, you can see, on a closing basis, it didn't quite hit it, but that doesn't necessarily matter to me. As long as it stays below this level, I'm looking at a bearish move on this thing. So And I can maybe move the stop up a little bit, but this is essentially, you can see the plan that I have. This is one of those on the Weekly Whispers list, which there's the whole list right there. We'll look at some of these. So yeah, I'm looking at nibbling on this thing. Might even look at it below the close or below the low of today. There is, I think, the target, the ultimate target, which may take a little while to get to, just depending if this market rolls over or not. Interesting. So Google's flat, Apple's down a couple bucks, Microsoft's down 2.5, and Tesla's down 4. Nvidia's up 9, which is no surprise. Meta's flat, Amazon's flat. So out of the Magnificent Seven, which is a big part of what's driving this market, right? See, even though, and that's one of the things that even though the overall market looks super bullish, it's a very, very thin breadth. There's not a whole lot of stocks that are driving it. Which the one thing I saw yesterday is that in 1999, if y'all remember that, I started trading in 2000, but I have looked a lot at the history of the late 90s, the irrational exuberance, the craziness that was going on in the market. In 1999, the breadth was very thin. In other words, a small percentage of stocks were pushing the overall market higher because the indexes are weighted. And if I remember right, somebody can correct me if I'm wrong, it seems like that those 7 stocks accounted for 38%. Maybe it's 28. I can't remember whatever number it is. It's huge. And the higher they go, the bigger percentage they become of the index. So you have a handful of stocks that are pushing the broader indexes higher because they make up for a huge portion of it. And in 99, it was the same thing. And today, the breadth is actually worse than it was then. In other words, there's a smaller group of stocks that are pushing the indexes higher. So it makes it look like the overall market is really kicking butt, when in reality, it's not so much. Yeah, like NVIDIA, exactly. You beat me to the punch by about 3 seconds. Yeah, I mean, NVIDIA's up $800. A year and a half ago, the thing was $180. And it's a massive percentage of the indexes, as are the other 6, right? NVIDIA, Meta, Amazon, Google, Apple, Microsoft, Tesla, what they call the Magnificent Seven. So you got to be cautious looking at it going, well, we're hitting all-time highs. Okay. We did in 1999 too. And then reality settled in and people realized that, yeah, maybe these things aren't as great, right? This is, and I've been saying this for months now, it's reminiscent, the AI thing is reminiscent of the dot-com era. Is lots of excitement, lots of energy around this new technology that's going to change the world. And it did, but in the late 90s and early 2000s, it was still new technology, and it took a lot longer for it to catch on and to get into the marketplace the way that a lot of stocks were there. Like, was it Webvan? I think it is. Yeah, .com part 2. I think it was Webvan. I kept looking for that name, and I finally stumbled across an article. It was the grocery delivery service. They had one of the biggest raises at the time. They raised $800 million, I think it was. And from a corporate perspective, this was some analysts went back and you look at how companies run things and how they go from startup to wildly successful. And they did everything right from a corporate perspective. Their moves, the things they did, where they put their money, who they hired, all this stuff they did perfectly right. The problem was that they were early. The technology wasn't there to be able to do what they were attempting to do. Because today you can get groceries delivered. I know the Safeway by my house has 4 or 5 trucks that sit out there that deliver groceries, right? You can get them Ubered to your house. There's all kinds of ways to get things delivered because the technology is there today. 25 years ago, it wasn't ready. And that's kind of the way I see AI. And I think Google just proved it, actually. It's funny. Yesterday I saw that. It's like, wow. Yeah, AI is not there. It looks like it could be great technology, and it probably will dramatically change the way we do things. But I still think it's too early. I think it's very similar to .com. Sorry. But who knows? You know, and that's the crazy thing is a market can stay. What's the old saying? A market can stay irrational longer than you can stay liquid as a bear. Okay, Trip. Good. Thanks for the. I'm not alone. And yeah, it's crazy. You know, that's the other thing I talk about sometimes is that Buffett stayed out of the tech boom, and everybody was calling him names. What an idiot! He's missing out on the greatest boom ever. This and that. And guess what happened? The bust happened. .coms turned out not to be all that they were cracked up to be. The bubble burst, and guess who got wealthier when the bubble burst? Buffett did, because he stuck to what he know. That goes back to my earlier point of stick to what you know. Buffett says, I don't understand the technology. I don't understand how they make money. I don't understand their business model. I don't understand this, so I'm not going to invest in it. He stuck to what he knew, and it paid off. And sometimes you got to go against the grain, right? Sometimes you got to look at it and say, okay, this looks good here, but inflation's not done. And I've been talking about that for, 3 months now. Because eggs, I bought eggs. I get this 15 dozen pack. I eat a lot of eggs. But at Thanksgiving time, it was making a lot of dirt. You use a lot of eggs. So I bought one. They were $20. By the time Christmas came around, I needed more. I went to buy another one. They were $40. Wait a minute. They doubled in a month? That's crazy. I'll wait. I was going to wait. And they got low enough like a week later. Okay, I need them anyway, so I'm just going to go buy them. I'm not going to wait for them to come down, right? Like you buy a stock at $20, and then it goes to 40. You're like, I'll wait for it to pull back and buy it again. I'm not going to buy it here because it's too high. Well, I needed it anyway, so I went and bought one. And then first part of January, just 3 or 4 weeks later, I was back there. I didn't need any more, but I was curious. I went and looked. They were $65. They tripled in 2 months' time. And then I was there 2 or 3 weeks ago. It's U.S. Chef store. It's a place that they sell mostly to like mom and pop restaurants, but you can go in there as a public and buy it. They have great deals on meat. I just got a brisket from there yesterday. But yeah, it was mind boggling. They were $75, $79 last time I saw them. So they went up 4 times in the last 3 to 4 months. 4x. I love it, Barry. Thank you. So Barry said the yoke is on you. The yoke is on you. Yeah, I'm glad I got them. I still have some. I haven't gone through. I still have the ones from Christmas time because I didn't. I discovered how to make eggnog last year easily, and how to make creme brulee, and people love it. So I made a whole bunch of it. But yeah, I don't know if I don't know if price gouging is the right way to see it. I mean, maybe, but I don't understand why the egg part has gone so dramatically. So there's not. I mean, if you go look at the food companies, so I don't buy into the price gouging thing. Look at the food companies; they're getting trashed. If they were price gouging and making massive profits, Kellogg's would be at all-time highs like everything else. But they're not. Look at them; they're getting trashed. They were $74 a year and a half ago. They dropped all the way to 48. Now they're at 50. Kraft Heinz, same thing. Most of these food companies. What was the other one that got trashed recently? The food companies are not doing well. So, if they're gouging, if they're making these exorbitant profits that people are saying they are, then why are the stocks getting trashed? Why are their profits down? It doesn't make sense. So I don't buy into the whole price gouging thing. I don't know what drives them. I will look at cocoa. Cocoa's a commodity. It just went to an all-time high, like spiked to an all-time high. So if you love chocolate, go buy your chocolate now because the price is going to go up soon. Because cocoa is obviously the main ingredient in chocolate. It's the most expensive part. So yeah, let that be a warning. I did that 3 years ago. I went and stocked up on a whole bunch of just regular household goods. They'd be on sale. I'd buy a whole bunch of them because I expected the inflation to come in. I expected things to get worse. So I've got razors for about the next 5 years. They were on sale. I'd buy a big old pack of them. So, yeah, I don't think the food companies are price gouging. That's my opinion. I mean, you're entitled to believe anything you want. I just don't see it. So, yeah, the eggs thing, it definitely is confusing why it spikes so much. So why are eggs so volatile? Because I go in there, they're $75 and the whole shelf is filled with these 15 dozen packs. Then they've got the other farm dozen. So maybe it's just a new inventory, but I don't know what the deal is. Cocoa did because they had, I think if I remember right, it was two different places in Africa that have, that create a lot of the supply, had like the worst crop in 65 years. So the supply demand thing is out of whack. So if there's not going to be as many supplies of cocoa beans because two different regions have a horrible yield, then that makes sense. But it went spike, just boom, real quick. So I don't know if I don't want to dig for it in here, but well, agreed, Brenda. But at the same time, they have costs, and the cost to ship and the cost of fuel, the cost that it takes to produce the goods and services is up dramatically too. So prices are up, but their costs are up too. They have to raise prices to make up for their costs. There's a guy here. I bought a sounds terrible. I bought a pig from. He's a local farmer, and he raises these. They're kind of a specialty type of pig, and he raises them for meat, right? And he sells them. He's a real estate agent, but he has as a side business. He does farming. I think he just loves it. But um, I bought one from him a couple of years ago, and now he actually cut back his production like 90%, like a year and a half, 2 years ago, because the cost of things went so high. The cost to get feed, the cost of fuel, the cost to raise the pigs went so high that he's like, I can't raise my prices enough to make a profit. I can't get my prices to a point where I can make a healthy profit and stay in business where people will buy it. I mean, I think I paid $750 for the whole pig, right? They sent it off to the butcher. I just went and picked up two coolers full of meat. It's all wrapped and everything, right? So I got a ton of bacon. I got ham. I got all kinds of stuff. But he's charging, I think, double that now for this. But he cut production by 90% because he can't keep up. He can't charge people what he needs to charge to stay in business. So he went from raising like 50 pigs a year to raising like 5 or 6 because his cost of goods went up so high. And it's no different for every other food producer on the planet. The fuel's getting more expensive. The fertilizer to grow the food is more expensive. So the farmers have to raise their prices. The fuel to run their farms. I mean, I know there's farms. I read an article here in Washington that the guy goes through 500 gallons of diesel on a daily basis. That's a heavy cost. I mean, he's got a big farm, but 500 gallons of diesel, your diesel doubles in price. And then the farmers are stuck selling at what the commodity prices are going for. So farmers get hosed when energy prices go up, unless the commodity goes up with it. So it's a supply and demand thing. Oh, interesting, Kevin. Yep. His wife works for 3M. Instead of giving them performance raises, everybody just gets cost of living, so they don't have to raise their prices as much. Right. So they're cutting back on how much they're paying their people. My brother works for farmers. And the last 2 or 3 years, they haven't gotten their bonuses. They haven't gotten performance bonuses that they usually get. So same situation. So they can't, because they have to keep their costs down so they don't have to raise their prices as much. And insurance has gone crazy because they have to, because everything else has gone higher. Right. It's this vicious spiral is all it is. So okay, yeah. I mean, I can see that, Brenda. Um, yeah, I don't see it as greed. I see it as them. They're just trying to make a profit, like every other business, and they're passing on the cost. I mean, they have to pass their cost on, otherwise they're losing money, and then they have to shut down. Right? If they lose, like look at Yellow. I mean, Yellow had to close down because they either didn't raise their prices or they were doing something wrong. Obviously, uh, I mean, every business and the grocery business is there's so many of them out there that I mean, if one company comes out and raises their prices and they get so high, guess what's going to happen? I mean, some other company will come in and say, you know what, we're going to beat their price. They'll price shop each other. They know where they're at. They know what their margins are. They know how much money they need to make to stay in business, and they adjust accordingly. Right? If I was buying a product for $3 and I mark it up 100% and sell it for $6, then it's $6, right? If my cost of that good goes to $4, if they're shipping it to my store, if the producer raises their price to 3.25, the shipping costs 75 cents more. Now my cost is $4. I'm going to raise my price to $8 to get my 100% margin, because I have to cover my overhead. I have to cover my rent. I have to cover my employees. I have to cover their insurance. I have to cover all these expenses. And most retailers double the price. So if at the wholesale level, the price goes up by $1, ultimately it's going up by $4 in the store. That's about what manufacturing. If you manufacture something for $1, the ultimate retail price is about $4, generally speaking. So if that $1 goes up to $1.25, doesn't sound like much, but that $1.25 just translated to $5 at the store. That little 25-cent raise at the wholesale manufacturing level translates to a full dollar raise at the store. And everybody's profit margin in the middle is still the same. It doesn't change. So, yeah, exactly. I mean, when there's so much competition that if you're making that much profit, somebody's going to come in and undercut you because they can still make a profit. If you're making 30% profit, somebody could come in and stay in business doing 20, they're going to undercut you and give you a better deal. You know what I mean? So there's so much competition now in almost every industry that it's virtually impossible to price gouge. So anyway, let's get back to role reversal. Talk about getting off topic. That's your fault, Brenda. I'm blaming you this time. You got on me before. I still have coffee, so we're good. But yeah, it's whatever it is, it's ugly. And unfortunately, inflation is not going to stop. I just found this out too. One of my best friends, I just went down to Oregon. He just turned 50 on Monday. And so we went down. He and his brother came up from California, and we met in our hometown and basically partied all weekend. Partied like old men. We didn't, we barely drank at all. We just played golf and played poker pretty much the whole weekend. But yeah, he told me they raised his rent like 12 or 15%. He lives in San Diego, not a cheap place to live. But he's got a little 2-bedroom apartment, and his rent just went up by 12 or 15%. I was just there in September. So, and those numbers with landlords doing that, the CPI number is going to get significantly worse. So this market is eventually going to realize that and freak out because CPI, that's why it freaked out the other day. When CPI came out last week, market got hammered for a day. And then it shrugged it off like, it's not that big of a deal. Because the market's been believing for a while the Fed's going to cut. Look at the pivot. That's what's created this rally. The idea that we're going to pivot. And there have been good reports out of some companies. But this idea that the Fed's going to pivot and start cutting rates, people were talking about 3 rate cuts. And now the Fed's even come out and said, we're not going to cut rates in March for sure. And now they're coming out, the report just came out yesterday or the day before, where now they're like, we might be too early to talk about rate cuts. In my opinion, they should be raising some more. And then bond prices dropped off again. So mortgage yields went up again, back above 7. They were down in the low 6s for a month or two. So, and that's going to hurt the housing market more than it already is. I mean, it's already at 30, 40-year lows as far as mortgage origination. So there's a lot of, things look good on the surface to a certain degree, but there's a lot of chaos underneath the surface that a lot of people aren't seeing and don't see. So commercial real estate, another bomb just waiting to drop, which there's I can't remember what the number is, 1.2 or $2.2 trillion of commercial loans coming due this year. And they have to refi at a significantly higher rate than where they got in. Commercial building went crazy because rates were so low. I mean, why wouldn't you? If you have money to invest in a commercial building, do it because it's dirt cheap. So either they have to raise their rates to make up for the additional interest, they have to raise their rents, and they're already, a lot of them are very high vacancy rates because of COVID, right? People working from home now. Oh, really? Interesting. Vacancy rate is under 1% in Manhattan. So yeah, they're going to keep raising rates. Why would they why would a landlord lower your rates if they have heavy demand? They're not. They're just going to keep increasing. So it's that's one reason that inflation is not going to stop. It slowed down a little bit last year, and it's going to keep going. It looks like. So yeah. So be prepared. That's all I'm saying. I mean, that's one of the beauties of trading short term, right? You just sit on the sidelines and wait until there's an opportunity, and then you get in and get out as quick as possible. So that if the market does go crazy and crash or something happens, you're either on the sidelines or you're on the side of the market that you're doing well on. So, I mean, there's a firm right there. Here's another one. We're actually kind of like Google. We're actively in a spot where we're getting a role reversal taking place right now. We haven't tapped it, but I mean, we got close, right? Here's support. It doesn't have to be exact, but wow. Yeah, that's normal. Hey, no, you don't get to move those. I don't know if you can see this. She's decided to sit down and she's touching the keyboard. She's pushing the buttons. The cat wants to let her teach. She's trying. That's crazy. Kevin said had to rent an apartment in 2020. Went from $1,250 to $1,926. That's a weird number. Yeah, $700. That's what, 60% in 3 years? It's massive. And the thing is, they can, because if you're going to buy a house, at least out in this area, a starter house is $500,000 to $600,000. Even if you put $100,000 down, your mortgage is still around four grand, give or take a little bit. So I mean, rent is gonna eventually catch up to that, especially if you're a landlord and you know that you can raise the rents because somebody can't go anywhere. Where are they going to go? Go buy a house for $4,000 a month. You rent a house for $3,000, so raise it up to $3,300. They're still in a better shape, right? It's just one of those things. So yeah, that's another one, Les. I appreciate you bringing that up. HOAs raise your rates because insurance. Yep. Yeah, I know. I just somebody a couple months ago was saying that their HOA rates went crazy high because insurance is getting more expensive. Everything's getting more expensive, and it's a downward spiral, unfortunately. That doesn't look like it's going to get any better. There's another one right here. What are you doing? She's literally laying her head on the keyboard. She's fun, but she's kind of crazy sometimes too. At least she's not drinking my water. Not yet. Oh, I know. have I have I shown the picture here? I've got a few where she literally has her paw on the mouse. She's sitting like here's the screen right in front of me. She'll sit right next to the keyboard and the mouse, and she puts her paw on the mouse. And I've taken a few pictures because it looks like she's sitting there trading, and she'll look back at the screen. I've gotten a few pretty good pictures. I've shown them a couple places, but uh, okay, now it's just annoying. I'm about ready to kick her off. There's Boeing. That's not a role reversal. There's the one that is getting bullish. BN. I don't know if that hit or not, but you want to see what the cat? There's her tail right there. No, I'm about ready to kick her off because she's starting to annoy me. I don't mind if she sits here, but when she starts to interrupt, CFG looking for a role reversal. See if there's anything just to, since we're trying to stay on topic. There's EOG got beat down on earnings. Fifth Third, GE's gone crazy. There's Google. We looked at that. Oh, the picture of her trading. You want to see that? There's Invitation Homes. This is another one that, we've got the neckline. We've got a decent little head and shoulders. And we're tapping the neckline there. So if it rolls over from here, I'll put a hook down here. I'll just keep an eye on this, probably see what it looks like at the end of the day. Doesn't look like it's going to roll over, but here's one that I love. Here's an opportunity roll reversal. We've got, we broke back below it here. Then we tapped it 2 days in a row, rallied up. I don't like the neckline, the slope is too steep, but it's there. Earnings came out, they got trashed. It's rallied back up. We've gotten back to the previous resistance. And at this moment right now, it's still sitting there. If it closes right here, I'll put a hook down here because we've got a pretty solid roll reversal. Anybody that bought right in here that went long is not feeling good here. Right. And maybe they came back and picked it up. Most likely it's a lot of short covering, right? Because if you got short on this anywhere up in here and you get that earnings move, you go from, if you shorted at 36 and you're at 34, $2 doesn't sound like a lot, but on a 36 and you only put up half, right? So you're putting up $18 to short it. You make $2 on $18, that's 12%. Intel for a long. Yeah, we can. I mean, there's a head and shoulders forming, but that neckline right now is support. So it might see what we got historically going on here. We can take a picture of her now. She's sitting here watching us. I'll see if I can find it. Let me finish up first, Brenda. Whoops. So yeah, I'm looking at Intel right now as a head and shoulders, but it very well could bounce from here because it's not that's it's a trend line that's not confirmed. We got 1 hit, 2 hits. I mean, I guess you got a few here, so you can maybe call that confirmation. If it holds here, it's actually not a bad bullish look. I would put a stop down below this level, probably just flip that over. We got this window that might need to get filled. Whoops. I forgot that this is backwards. Okay. You can kind of see her head here. She's literally watching the mouse as I'm drawing this stuff. I think she wants to attack it. It's so weird. I never thought I'd have a pet, let alone a cat. Now I'm like one of those weird, crazy cat ladies. I got one of my best friends, though, too. He's got like 5 or 6 cats. It's crazy. Like, one's enough for me. I don't have time for a dog. Otherwise, I'd have a dog. So yeah, if I was bullish on Intel, which I mean, I can see that happening. I put a stop just below this 42.24 and then a hook above, a little above the high of today. So 43.64 with a target up here at the fill of that gap. I mean, it's not a bad look because we do have that, it's essentially, it's a little bit of support right here. I'm just with the overall market as high as it is, I'm expecting a healthy profit-taking haircut soon. So if the overall market drops off, is that going to drag Intel with it? I don't know. It just depends on your perspective of Intel. So I think it could go either way. I wouldn't take a lot of risk on the upside myself, but that's me. So just because I think the odds of a pullback, possibly a heavy pullback, are higher than continued rally. But I've been wrong before. Once, right? Let me get rid of that. Let me see. Any other questions? See, she sits right here, right in my way, and I can't see. I gotta dodge her, try to get around her. Trying to remember where I put those. Yeah, I don't think that's a bad move, especially if you're doing it as a hedge. I mean, if you're in a bullish position in the market and you aren't sure whether or not it's going to keep up, then it's not a bad idea to hedge your position with somebody short ETFs. So, and it's down, I mean, it's $11, which seems kind of crazy. It's hard to see that with that because it's low, but yeah, it's a great hedge. Or, if you don't believe this market's going to continue to rally, think we're going to have a pullback, this thing could pop if the market sells off, obviously. So this is the short, if you're not familiar with it, this is the short ETF on the Qs. So it's an inverse. It goes the opposite of the Qs. So, but yeah, I don't think, and if you have long portfolios, if you're holding on to stock, I don't think that's a bad thing because we could have a year like 99 and it could just keep on going. But it's never a bad idea to hedge, whether you're buying puts or buying a short ETF to hedge your bets, just in case this thing rolls over. Ready, Brenda? There you go. See? I've got a few of these actually. She's done it a few times. It's so crazy. She's like, hey, what? Wait, what? You're bearish? I know. It's pretty funny. And she's just holding on to the mouse, like, oh, that was a while back. I had a different setup then, but she's looking like, yeah, nah, I'm not gonna worry about this. But yeah, I've gotten her, caught her a few times doing this. It's pretty hilarious. So she's I didn't know anything about Maine Coons, and apparently they're very dog like, and she is. She'll play fetch. She'll come up and grab a paperclip or something on my desk, and I'll throw it. She'll go grab it, chase after it, bring it back, drop it. She'll do that 2 or 3 times, and then she's bored. Yeah, she instinctively knows it's a mouse. She might. I mean, she's literally that's happened probably 5 or 10 times. I just happened to catch her, but she likes to be in the same room. That's why she's always here. She just left. She gets up on there. She'll come sit here. She'll get hot on the router. She'll come sit here next to me. She actually did place a trade one time. She literally stepped on the keyboard. I had an order sitting there ready. And I don't remember if I walked away or what, but I heard some bells going off. I'm like, wait a minute, what's going on? Like she literally hit the button. I'm like, it turned out well. Ended up making a little profit on it because I was about ready to just get out. And I thought, I'll wait for a minute and see if she's any good or not. And sure enough, she made a little profit. So I was like, all right, maybe I'll give her another shot. So yeah, it's pretty crazy. So pretty crazy, but she's been a lot of fun. Like I said, I didn't expect to have her. I think wasn't gonna get an animal at all, but she's been a blast. So any other questions, comments before we call it a day? I agree. I like the low maintenance aspect. I've got an auto feeder for her. I got a big water thing for her. I got an automatic litter box, so I don't have to do much, which is one of my rules. If I'm going to get a pet, I need low maintenance. Taking our dog for a walk every day, too much. Having to pick up their stuff, like, yeah, no. Sorry. My dog sit for my brother when needed. So, all righty. Well, we are going to call it a day, and y'all have a great weekend. We will see you shortly in something, either Trading You or this again in a few weeks. Wherever we see each other, we'll have some fun. All right. Y'all have a great day. God bless. Bye-bye.